Alrighty, good evening for those who are joining. We're going to give other participants about a minute to join the webinar this evening, and then we'll get started at about 5:02. Alrighty, so it's 5:02 now, and for those who have joined us, thank you and welcome to our home purchase webinar this evening. We will be discussing the home purchasing process. I'm Suhei Mojica, and I'm the Business Assets and Manager of the San Pablo EDC, and presenting with me tonight is Emma Biggie from Bank of the West. But before we get started, this webinar is being recorded. Our recording will be available on our website at www.sanpabloedc.org, and any resources mentioned during the presentation will also be available on our website. We welcome all your questions, so please type them in the Q&A box. There's also a chat box if you prefer to use that as well. We will answer all of your questions at the end of the webinar since we have a full program this evening. Okay, and just before we get started with our presenter today, I just want to give you a little bit of background on what the San Pablo Economic Development Corporation is. And basically, we are a full service organization for economic growth in Contra Costa County, as well as Alameda County. We're here to help you establish the critical connections you need to succeed in a diverse business ecosystem. We also provide a broad range of affordable housing opportunities and services to enable low to moderate income residents to gain better housing and financial stability. We also offer various workforce programs for career training funding, childcare funding for working residents, and on-the-job training and much more. Again, if you would like more information on our services, please visit our website, or you can call us at 510-215-3200 for more information. We'll add that information on our chat box so that you have access to that. And now, just to get started with our presenter, this webinar was possible with the help of our wonderful partner, Bank of the West. We are very grateful for their partnership and collaboration with the San Pablo EDC. And again, as I mentioned, today, Emma Biggie from Bank of the West, who is the VP Community Lending and Diverse Markets Business Development Officer, will be going over the home mortgage lending process and how to prepare. So now I'll turn it over to Emma, and welcome.
Good evening, everybody. Thank you, Sohee and Jessica, to introduce me and have me tonight to give the presentation on home ownership. My name is Emma Biggie. I have been in the business, especially lending business, for the past 20 years. Majority of the time I spend is in origination. So I understanding and know the lending from A to Z, even from the different perspectives. So tonight, let's share the knowledge together and let's explore our home ownership, the path to the home ownership. I'm going to share my screen about the presentation. Wonderful, thank you. So I believe everybody can see this presentation, right? Let's move. Okay.
Yes, we can see it.
Okay, thank you, Sohee. Before we started the material, I want to make a disclaimer because tonight all the information we share is of a general knowledge generate information is not pertain to or involved a specific case or file or a specific request, loan request with a certain lender. So anything, if anybody in the classroom already being contacted with a lender and discuss a certain lending practices and lending product and services, you do need to fall back onto your specific lender to get into the detail. Now, let's talk about a home ownership. Benefit for home ownership, a lot of this type of information has been floating around, and we all know benefit of a home ownership. First, we have a pride to own the home of our own. That's a piece of asset, build up the foundation of wealth. And also we develop the sense of a community because we care where we are and how we live there. So that's the basic for the community, and also personal achievement without a doubt. But that's just a general idea for home ownership. Now, then the specific how we obtaining the home ownership, there's quite a few steps, or we see is a procedure to follow. The first and foremost, we need to understand our credit. We understand the credit and not only just understanding, we also need to know how to manage it and also how to repair and how to fix certain problem with the credit. Then we are going to, after the credit, we need to know the money talks. We need to know how much we can borrow, how much we can afford, and how much the lenders are willing to lend the money to us as a consumer. After that piece, we really stepped into the specific action. How are we going to get this money? Specifically is from consumer side, we need to know what type of a product and the services the lender can have for us. And also from a lender perspective, the lender needs to do certain things to verify the borrower's candidacy for get the money. So those are very, very specific steps, and they involve certain actions and involve certain documentations that are hard evidence to support. And then after that, of course, we're going to go after the real piece, the tangible asset, which is the property we're willing to purchase or to find, which is called home. So those are the general, quite a few steps for obtaining the home ownership. Now let's start it from the service, understand the credit. Understand the credit, there's a lot of perspectives, a lot of sections we really need to understand. But what's the core piece? The core piece is right here. Everybody look eye on the screen, is understand the credit score. Where's the credit score coming from? The credit score is a snapshot about our credit behavior. And this behavior has a long history and also documented that history and come into a report we call the credit report. So credit score is a scorecard for that report. The report is a history and share the stories, what we have done for our credit, how we behave, how did we do with our credit. And then credit score is a summarize how good we are and how much we have achieved. So by looking at this pie chart, everybody already see what is really involved considering talking about credit. On this chart, we're really looking at 5 major categories for the creditors or people lend us money or people judge our credit behavior. What's the base they judge? and how much weight they gave for certain behavior and rendered certain score. We're just using the school system. 100% is a perfect score, right? So the 100% points for the credit score on the scorecard, what we can get out of these 5 categories. First, let's look at the left side when we facing the chart. One is a 35, the other one is a 30. Those are carry more than 50% of our credit weight. What are these category? Payment history and amount owed. So payment history is a simple behavior, is how are we dealing with our payment? Do we pay the bills on time? This is a very important behavior, is showing other people's our credit worthiness. If we pay the bills on time, that's show our characteristic is being responsible, and also showing we have a very strong strength to manage our credit and manage the money. Because credit is one word to translate it to say how we maintain the financial good behavior. But really in that financial, what is involved in financial behavior? That's involved the money, how we handle money. If we handle money outright, the payment history will show. And that's why the payment history carry the most weight. The next carry the most weight is the amount owed. Amount owed is telling people how much we own the people or own other creditors or lenders, but also that's showing how much debt we carry in the household or how much debt we can handle, because liability, which is the debt, financial liability, the debt is considered as a burden. So how much we can carry that burden is showing on this category is amount owed. 30%, this 30% number actually also a tip for everybody to consider. That's an ideal number for the household to have how much debt you can have in the household, income versus the responsibility. Why 30% is ideal? Because normally in the lending business, we are talking about the gross income, the gross revenue of the house. So we don't take the tax discount into the consideration. For that, we have to leave some space for people to really do some calculation to say what is the ideal way for the house to carry the debt. Because in reality, the money we handle in real life is after-tax money, is not a pre-tax money. So that's why a lot of times people ask, say, well, it seems like you set up a 30% is quite a low bar there, but actually it's not. You're thinking, just to consider, let's take an example. If we make $100 per month or per year, we're just using that $100 as an example. Our tax, pre-tax money is $100, but for the taxes, normally the tax bracket is around 30%. So in other words is, if we make $100, but really the money for put into use in daily life is only $70. And for that purpose, you're thinking 30% of that, 30% of 100 for gross income, but used for after-tax money. That's a quite a large piece there. So that's why just to be careful why we should we set a par for 30%. Then we look at the right side, there's 3 items is on the smaller percentage, but it's also very important because all those show the characteristic of our behavior, and also to demonstrate our skill for how to handle money and how well we can do with the money. New credit basically is talking about, do we open a lot of new bills? Do we open a lot of debts? This is demonstrate how disciplined we are to handle the money. Length of credit history is to show our characteristic, how mature we are to handle the credit, the concept even, because we know credit actually has two meanings. One credit means trustworthy piece. The other credit means money itself. So length of a credit history is applied to both of them. The both of them is to say how well we understand our finances. And the other one is how long we have been in the capitalism system and knowing the money, value of the money. Then the last one is credit mix. This is just purely talking about how mature we are to know the money sources and how to handle them, because credit mix is regarding to different type of the money. Any questions on this piece? If you do have any questions, please put it in the Q&A so we can answer that in the end. That's a piece that's talking about, most important piece, talking about a credit score. We understand those credit score, the categories, and how much weight they carry, how other people judge us based upon our behavior. Then we know how to manage that, because if any incident happen in a certain category, we know how to find a solution to fix that, the issues. Well, to understand the credit, we do need to know where to find them. So this slide basically is to tell everybody is a resources piece. How can consumer to access our credit report, credit history, which is annualcreditreport.com. This is these three bureaus set up the platform for consumer public access to fair credit behavior credit report. That's the platform. One thing just to need to be mindful about this is this website, they gave the free credit report, but they don't provide the credit score. If you do want to access the three bureaus of fair credit score, you do need to go to the different website, which is myfico.com. So that's another website is very useful. So this one, to get a free credit report, is annualcreditreport.com. The other one is myfico.com. And of course, this slides actually provided the contact information for the credit, the report platform, and also the reporting system, the service. Why we need this? Because if we have something happened to our credit history or behavior, we need to report things. This information is become handy, because of credit bureau are still old traditional way for doing things. This is in line with the legal system. They need hard evidence. So a lot of times it's not just the online business. They also need us to provide the handwriting, the letters, and the other documentations. So mailing address is very important. Now, we talk about the credit, we talk about the report, we talk about the source to get those information. But we also need to share some tips of how to maintain and manage the credit. This is very important because credit behavior is going on daily basis. Every day we handle money, every day we're spending money, every day we make an income. So as long as all this behavior happening on daily basis, our credit is rolling. So for that, we need to know how to manage that and maintain the ideal or plausible level for this. First and foremost, build the credit file. Build a credit file, that means is we need to have established credit. So if we do not have enough credit line, we need to open more to build the portfolio to really showcase who we are. Because remember, we talk about the credit score system. That's the profile for us. We need to showcase who we are, how we do things. So it's not just the one single line or two single line will tell other people how we're doing. We need to give them the multi-phases, how we handle things. And also, second is don't miss payment. This is very, very important. That's why we show the pie chart. The number one category is 35% payment history. Payment history carry the most weight, and also because carry the most weight is can happen more often, has mistakes in that section. Why? Because it's so trivial. Payment is, if you compare your other things, payment behavior is quite minimal. We know we spend money, and then we know we need to pay them back. That's just simple like that. But behind it, we also need to understand how to discipline ourselves to allocate money and make sure to do the budgeting and planning and to secure the money and satisfy that payment. So there's a lot of work on that, but that work is ongoing. So sometimes people can forget, and also just to make a misstep for payment, and that will cause the trouble or cause the problem and damage the credit. Catch up on the past due accounts. This is also very important. Normally, a lot of people, this is related to the payment. If we delayed something and we're behind, we normally want to fall back to the track, but we need to understand we have to make extra step, because when we behind, we're not only behind for that month, we're also behind on the interest they charge every day late. So in that sense, whenever we're behind, we do need to contact the creditor to make sure that behind the bills doesn't have a lingering issues like piled up the behind the interest, and also have some legal consequences too, because sometimes can have the legal punishment type of fees involved. So those type of things also need to catch up. So this is something for everybody just to remember. It's not to say, hey, I have been paid this bill for $30 every month. I delayed it for 1 or 2 months. For next month, I just still paying $35. I will catch up. I'm catching up, which is no, you are not catching up, because the delayed piece, the gap piece actually is mounting up, because there's not only the money principal you pay back, there's also interest involved, the penalty involved, the fee involved. So that's something is to be careful. Also is limit how often we apply for the new accounts. Here is a thing. A lot of people say, hey, Emma, I do not like to own people's money. I don't like to own people's money either. But that's not what we do in this society, because here the society is a capitalism society. A lot of times people rely on each other's on the credit. Credit is our financial reputation, is also our personal reputation too. So for guarded that reputation, for develop that reputation, we have to use this capitalism system. So for more or less, we do need to purposely set it up to using the credit, instead of we're totally shutting us out from the system. If we're using the cash only, what are we going to see? in the capitalism, we're not seeing anywhere. Why? Because we're not showing any faces. There's no search, no existence for us. Why? Because we don't have a transaction. Capitalism system, the credit system actually is a transactional system. So they want to see you doing something there. So once you're doing that, the records established. But there's a measurement is how much we need to do and how far we can go. And believe it or not, capitalism system has a lot of traps and a lot of attractions. And they will seduce us to do a lot of things may not be necessary. So in that case, we need to draw on the line what is necessary for us. This is a fallback on our financial 101. We need to know how much we make, what our capacity is. And that's fall into that old saying, we have to live within our means. We do need to know where our means is, and then we need to set up the boundary. So do not overstretch and do not over expanding ourselves, but also do not shrink and shy from the whole system. So there's something is we need to find a perfect balance point. Then the other thing is, if we have issues, what are we going to do? We need to find help. Where the help is the HUD. The HUD Association will be the one major source for a lot of first-time, especially first-time home buyers, to get some information regarding obtaining the credit, obtaining the histories and how to deal with the banking scenario and all those. So definitely HUD.gov, that website will help a lot. And also talking to our counseling agencies to get information. Like here in San Pablo EDC is educational institution. So we encourage customer comes in to talk to our counselor like Jessica and Sohi and ask questions. Is this something we do all right? Or there's something I can get extra resources? So there are a lot of help there. So don't forget, you are not alone there. Even you may not understand a lot of industry detail, but definitely there's resources you can depend on to get that information. Now, talking about purchasing the house, definitely we need to mention something is a down payment. What is a down payment? Simple. Down payment is the home buyer's personal investment to that purchase upfront. That's just simple like that. Is called a down payment. This down payment is to show how strong the home buyer's asset are or is. So down payment also showing for the lender, which is we're going to borrow the chunk money to purchase the property, to showing the lender how strong we are financially. Why you say, well, down payment, why to show the strengths of them? Because where's the down payment coming from? The majority of the down payment coming from can be from our savings. So that's showing our ability, how can we save the money? And also saving money, fall back to our characteristic is a discipline in allocating money. So those are all come together there. Well, nowadays, down payment has a different essence, concept, or different nuances in content there. So I believe at the end, the Songhi is going to present something in detail about down payment. So here I can stay on the surface just to tell everybody is personal investment upfront. The investment, the money can come from variable or multiple choices and multiple sources. You can be a personal savings, can be the personal long-term investment cashed out, or can be seek the third-party resources can be used for the down payment. Of course, the down payment can from the third party can be a free money, which is we call a grant. Also can be a low interest loan we borrow because that program is designed to help people in need for the down payment. Regardless, down payment is one of the necessary step in the home purchase, and actually has a key meaning for home buyer and for the lender. After all those, we talked about credit and the general, the lender's piece. Let's just look at some specific. This is more into to get into how are we going to specifically get the money, and how the lender looking at the consumer, looking at the public, the judge, the candidacy for the money. So there's a couple of things I want to mention. First and foremost, for the lender to decide how much money they are willing to grant to or issue to loan to the person request is the income to debt to income ratio. This is a very, very important, because for lender, that's going to be, it's almost a hard drop there, is going to decide how much money they're willing to lend it out. Why? Because that ratio is tell lender how much money in that household, where's the money being spent, and what's the portion money goes to where. It's a resources allocating. So debt to income ratio, the main thing, the lender will going to look at two pieces. One piece is a housing ratio. So basically is everything the person is spend on the house versus their income. That's a big chunk. Of course, in the future, especially projection, purchasing the house, you borrow the money, that will be a big debt liability there, big expense there. Why? Because we are talking about the mortgage, we borrow the money from the bank. We also talking about to pay the house, the insurance and the property tax, all those add up together. But those added things together, items are related to the house, has nothing to do with other long-term debt, which I was talking about a credit earlier. Because before you purchase the house, you already have a credit liability. Now, the other piece for the ratio we talk about, beyond the house, we also need to add the other credit debt into the consideration, because before we purchase the house, that debt already exists. So it's not because we purchase the house, the debt is going to disappear. No, that's just going to be add more debt to the household. So the lender wants to know.
Make your computer easier to use. Windows will read and scan this list automatically.
I'm sorry.
Press the space bar to select the highlighted option.
So the basic
narrator reads aloud text on the screen. Button on. Windows sign in window. Password. Edit.
So basically is
hidden.
So basically is for the house ratio and for the other credit ratio altogether, the industry has some standard to what we see is a benchmark standard. So for the lender to using that to see how good or how much room the borrower has or the person has in the household. The lending benchmark is 30% for the housing and 40% for the everything add up together. In other words, more specifically, is the 33 and 43. In between, you can see there's 10% different, because the 10% is counted for the rest of the household long-term, the credit liability. So if you are when the lender calculate the household income, the to debt ratio is landed in around this benchmark. That means the household, it has a very strong financial position. But if the ratio is much higher, then the lender is going to be more alert and really looking at more in closely about the debt combination, and really decided how much more debt the person wants to carry and wants to borrow, because the debt ratio will decide how much lender are willing to lend. Now, down payment, we talked about it. I just want to, give a roughly idea here. Normally, down payment for the first-time home buyers, especially conforming loans, the basic requirement upfront is 3%. So the different product has a certain requirement for the down payment. Just to remember, whatever the percentage required for the lending, the customer can find the money to fill that gap. So 3%, the 3% can be savings, 3% can be borrowed from the third party, and 3% can be a grant. Well, if it's a 5%, the customer can follow the same rule. So in this case, the down payment actually has a lot of a flexible room there, or space to play with. The other piece I want to mention is closing cost or transaction cost. This is something I always, in the classroom, I always tell people is we need to change the consideration for looking at the closing cost or cost of this transaction, because everything in the business has a cost. Everything, because it involved human labor, it involved resources, it involves the people's services. So cost is there, but who paying the cost will be a big question mark, because in a home purchase transaction, we are talking about the home buyer or the customer borrow the money to purchase the house, but actually there's a group involved this transaction. Since this is a group activities, so there are some other ways can help the home buyer to minimize some cost. So that's why I want to tell everybody is bear in mind transaction cost is always there, but we need to look at it closely. What are the costs on the paper, and who can help us to pay the cost? And this is something need to fabric into the conversation with all the transaction parties. So when you really get into the first-time home buyer HUD classes, you will know what are those transaction parties. Of course, a lot of people say, oh, I already know, is my agent is there. Yes, that's true. The closing company is there. The appraisers there, the inspectors there. So there's all kinds of transaction parties there. Just to bear in mind, transaction cost is there, but also other transaction party can help to minimize the buyer's cost. PITI, this is what we call the famous term for the mortgage payment. Why is PITI? This is basically talking about what's the household payment there. Principal interest, that's basically talk about we borrow money from the lender and we pay back the money, and the money charge us for using the money. Tax is property tax, and the insurance is the insurance involved to protect the house. And also sometimes we have to pay the mortgage insurance to protect the lender, which is we need to borrow more money out of the lender, and lender need to have some insurance. The other piece talking about the homeownership procedures is lender specific, is pre-qualification and pre-approval. Those are the two terms we talk about a lot. The reason for that is that specifically involve the steps the home buyers to know, am I ready to purchase this house? How can I get ready? So pre-qualification basically is a rough estimate. There's no hard evidence to support the conclusion. And also there's no guarantee whatsoever for how much money the consumer can get and how much lender is willing to lend. Pre-approval is on the other side. Pre-approval is a very specific action the buyer and the lender, and also sometimes involve the agent to get the action on, to get a hard evidence from the lender to really showing how much does the lender want to lend and willing to lend, and how much the consumer can borrow. So pre-approval is more solid evidence to support the transaction. In reality, who do we want to, which way we should go is depends on, are we ready for this transaction or not? If we just thinking to start saving money to purchase a house, what are we really looking at it at this moment? We want to get a pre-qual, not a pre-approval. Why? Because we're still far from, we're ready to get a pre-approval, to get all the money source done as a situated. But for pre-approval is we already got our down payment sourced, we already got the credit fixed, we have established everything, employment history, and we're just need the lender give us money, give us a pledge so we can find the house. If that's the case, pre-approval is a way to go. So this is a more 2 stages to show how ready we are, or how ready are we for this. Talking about home lending, we cannot avoid to looking at a mortgage product and the programs. For this piece, I actually won't talk too much because I can tell you it's product and the programs, there's an ocean there. So as a consumer, once you are ready, you are not going to just facing 1 or 2. You are facing the whole pool there, the choices. These choices is also choose not only product and service, is also specific lender to provide certain product and certain services. So I will leave this for the consumer to go start, get ready and talk to the lender on one-on-one base and really looking at some specifics, because this is very, very personal. Even we gave you some general idea, the conventional loan, FHA loan, VA loan, jumbo loan, all those names, but come down to the specific, which loan will be my loan? My loan is the best loan because that's served my situation. That loan can be FHA, can be convention, can be jumbo. So how do I know? I need to talk to the lenders to get the specifics. But overall, we do need to know some basics is fixed rate, adjustable rate, right? So fixed rate has some security. You got a fixed rate, you won't expect to change something. Then at adjustable rate, this loan product can change sometime in the life of the loan. So that will prepare for the change and give us something to think about it. Here is a specific loan product. I just gave a sample. It's tasted for. This is the Fannie Mae first-time home buyers program. You will see the very low down payment. They only require 97% borrow money from the lender. It only requires 3% down payment, and the lender can lend at 97%. There's a lot of other good things. A flexible source of a fund. What's the flexible source of fund? Basically, the 3% down payment. If the borrower can secure the third-party down payment help, you don't need to have even come up with that 3% out of your own pocket. So those are very, very flexible features for this program. And also mortgage insurance can be cancelable, because a lot of other programs, the government programs, the mortgage insurance, if you borrow a large loan from the lender, the lender may require the mortgage insurance to ensure the lender's money being paid back. Well, overall, what we consider is, is that possible? We own the home? Yes, definitely. Is that possible for qualify a loan with a certain help? Definitely, because the pool, the money pool is very large. The solutions are there. It's really up to us, consumer, to really understand it and also explore, ask questions. So that's pretty much concluded for our lenders part. I know we scratch on the surface, but I do believe I gave some key elements. I would like to give the stage back to Song-hee and talking about down payment system program, because that's one of the piece a lot of consumers are really worried about it and really care about. And that actually is a first step to pursue the home ownership. Song-hee, back to you.
Thank you, Emma. I'm going to go ahead and present now in regards to some of the down payment assistance programs that we offer or administer here at San Pablo EDC. So far, you heard about mortgage lending and how to prepare and what to expect. So lastly, I would like to present about additional resources for low to moderate income home buyers. One of the first-time home buyer down payment assistance programs that we administer at San Pablo EDC is called WISH. And as you can see here, let me just make sure that I have the correct information, is WISH stands for Workforce Initiative Subsidy for Home Ownership. This is a down payment assistance program that provides $22,000 in down payment and closing cost assistance. The funds are awarded as a 4-to-1 match. It is required from the home buyer to receive the maximum available assistance to provide $5,500 of their own contribution as a down payment. No payment is due. 20% of this funding is forgiven for every year you reside in the property. And then after 5 years, 100% of this grant is forgiven. Funds are available on a first come, first served basis with a fully executed purchase contract. And obviously it is subject to availability of funds. WISH funds may be only used toward down payment or reasonable and customary closing costs in association with the purchase of a housing unit to be used as the primary residence of the home buyer. And we'll discuss a little bit of the qualifying criteria. So one of the qualifying criteria is the family income must not exceed 80% of the HUD income limits. If you, let's say, for example, live in the Oakland, Fremont, California HUD metro area, which includes Contra Costa, if you're in the Contra Costa County. Borrowers must be a first-time home buyer. Borrowers must occupy the property as a primary residence. Borrowers must complete an 8-hour HUD-approved first-time home buyer education. As we mentioned earlier today, Emma said this is a 1-hour just informational webinar just to see if this is the next step that you want to take, is to fully move into the buying process. So there is HUD-approved providers, and we do have that on our website if you are interested in doing this 8-hour HUD-approved home buyer education workshop, you receive a certificate, and that certificate is good for 1 year. So in the process that you're searching for a home and working with a lender, it's always good to take this at the beginning so you know exactly what to expect in the home buying process. Another of the qualifying criteria is that the debt to housing expense ratio must not exceed 35% of the gross household income. But I want you to keep in mind that that has changed a little bit in the last few years. They're a little bit more flexible, so this really isn't a hard rule anymore. What they will do, the member bank who actually provides the funding will look at the particular case that is being presented, and based on the explanation provided, they may be able to do a higher percentage on the debt to income ratio. And then lastly, this is for a single family detached home. Condominiums and townhomes are eligible for this type of funding. No mobile homes, manufactured homes. There's another list of other homes that are not eligible. So they are very particular about the property that you're purchasing for this type of funds. And then the next one that we administer here at San Pablo EDC is called SPLASH, which stands for San Pablo Loan Assistance for Sustainable Housing. This is utilizing the San Pablo Successor Agency HSA funding. And the mission is to help low to income individuals become first-time home buyers in the city of San Pablo. Just to move forward, when we go into the differences about SPLASH, is that WISH can be used anywhere that any California resident is looking to purchase. SPLASH is solely for anyone that's looking to buy in the incorporated area of San Pablo. So what is SPLASH? It is the loan type is that the loans are made through the SPLASH program will be a deferred payment type of loan, which is also known as a silent second loan. No payments are required until the property is sold or otherwise transferred, including refinancing. The loan amount for SPLASH is a shared appreciation loan with a 30-year term for up to 20% of the purchase price of the home, not to exceed $100,000. Loan interest, the greater is the shared appreciation, or 3% for the annual simple interest. Prepayment, the borrower may prepay the loan at any time without any penalty. And again, the loan length is up to 30 years. Again, the qualifying criteria is that you must be a first-time home buyer. It's intended for qualified low-income first-time home buyers seeking to purchase a home in the jurisdictional boundaries of the city of San Pablo. And there is no exceptions for this because of the type of funding that is being made available. Borrower's eligibility, the borrower and the borrower's household must meet the income requirements and must agree to continuously occupy the property as his or her principal residence. The use of funds may only be used for down payment assistance or non-recurring closing costs. And there is a priority for first responders and teachers and veterans. Again, there is a debt to income ratio that needs to be met. But again, just like I explained with WISH, there is no hard rule. It could go above the 40% debt to income ratio. And again, it would be based on the explanation as to why that debt to income ratio is higher than that 40% requirement. And again, when you submit an application, they will definitely explore and see how they can make this loan work for you if it is above the 40%. And then again, let's see here. I want to just basically say that both SPLASH and WISH, they both work with many other down payment assistance programs. So you can actually work with many other programs and use more than one. For example, speaking about SPLASH, it complements WISH, HFA, Cal HFA, Community Reinvestment Act loans, Economic Opportunity Mortgage, School Teacher and Employee Assistance Programs, My Home Program, Mortgage Credit Certificate, Tax Credit Programs, and then another one that's not mentioned here that I believe just received new funding is LIFT, And there's many others that are out there. The key here is that you work with an experienced first-time home buyer lender that really understands this type of programs and can work with you in your home buying process. And with that, I just want to move forward in terms of what does it actually look like when you're applying for this down payment assistance programs. First of all, we recommend that you review the qualification requirements to make sure that you actually meet those requirements before you get started. And one of the ways that you can do that is you can definitely visit our website. We have many informational videos that talk about, just as we're speaking here now, we have the complete guidelines to explain step by step. So definitely review the qualifications and confirm that they meet the established qualification requirements. The next thing would be definitely work with and pre-qualify with a lender. This will help you guide you in your house search by knowing the maximum a lender will loan to you to purchase a home. And then finally, once you know how much of a home you can afford, you definitely would need to find a great real estate agent that can work with you, knowing that you're going to be using this down payment assistance programs. And then the next, once you've done that, you prepare and submit a complete application packet to the program administrator. In this case, we administer both Wish and Splash. With the application, you will get a list of documentation that you would need to submit with your application. And that would be anything from income and asset verification of all the household members to confirm that you actually income qualify. And for Splash, there is a $100 non-refundable application fee that comes with it. And that's only for Splash, not for Wish. And then obviously you need to have your certificate of completion of a HUD certified first-time home buyer workshop. That is no more than 6 months prior to the application, although those certificates are good for up to a year, I believe. And Emma can confirm that. And then lastly, we've created this roadmap, which basically tells you all the steps that are, that you would anticipate as a first-time home buyer. And we also have this this PDF roadmap if you want it. We have it on our website and we can email it to you. And having said that, that is definitely our presentation today. It's 5:58. I don't know if we have any questions. I don't see any on the queue. And if you don't want to ask your question here, that's okay. You can always email us. If I will share our information here. This is my information on the left or on the right of your screen. And then we also have one of the lenders, mortgage lenders from Bank of the West, who can definitely answer any questions that you may have about any of the topics that were discussed this morning. And so again, I want to be respectful of everyone's time. If you don't have a question right now, or you don't want to, you can definitely type it into the Q&A. And while we wait for that, I don't know if Emma, if you have any other comments or anything else that you would like to include before we conclude our presentation today.
Thank you, Song-hee. Yes, my comment, my comment it will be is don't give up. I know nowadays is hard. Market is hard. Interest rate recently this year is raising up. Inflation, economy, everything. People's mentality being impacted by a lot of outside elements and causes. But homeownership is the core. This involved our own life and also for a happy life. So don't give up and just keep working on that. We're here to help you. So I would love to see you on the other side to own the house, and we can provide our services to you.
Okay, and I do see there's a comment here on the Q&A. One of the attendees is asking to send information to their email, and what I do, it's not really specific, but what I will do is send you a copy of the slides that we shared today. we'll also send you a link to our website where we have all of this information in regards to, first-time home buyers, down payment assistance programs, and preferred vendors in terms of mortgage lending. If you're interested in speaking to someone more in regards to knowing how much of a house you can afford and what your options are in terms of becoming a first-time home buyer. I'll make sure we do that. I believe you are registered, so we will have, I just wrote down your name, and I'll make sure that we send that information over to you. With no further ado, I believe it's 6 o'clock now. So what I want to do is thank our presenter, Emma Biggie, for sharing such great information as always and resources. And then also thank you for everyone who made time this evening to join us and to learn more about becoming a homeowner. Again, if you want to follow up, specifically with any of the contacts that we have here, please feel free. And again, for those who asked for information, I will make sure that we follow up after this webinar with some links and more information as to what was presented here today. We are working on our calendar for 2023, so please stay tuned. Definitely check our website. We will have our calendar up hopefully by the beginning of January so that everyone knows what other workshops and webinars we'll be having in the year of 2023. So again, thank you, Emma, for all of your time as always and such great information. This is actually our last housing webinar of the year. So thank you so much, Emma. We've been having them every other month, and we definitely look forward to our continued partnership. So yeah, thank you again, and everyone have a wonderful evening.
Happy holidays. See you
Thank
next
you.
year.
Alrighty.
Bye-bye.
Bye-bye.